What are the main factors driving the property boom in Australia? There are several factors that have contributed to the surge in house prices across the country, such as low interest rates, government stimulus, limited supply, strong demand, and increased savings. First, low interest rates have made borrowing cheaper and more attractive for home buyers and investors. The Reserve Bank of Australia has kept the cash rate at a record low of 0.1% since November 2020 and has indicated that it will not increase it until 2024 at the earliest. This has lowered the cost of mortgages and increased the affordability of housing for many Australians. Second, government stimulus measures have supported the housing market during the COVID-19 pandemic. The federal government's Home Builder scheme, which offered grants of up to $25,000 for eligible owner-occupiers to build or renovate their homes, boosted the demand for new dwellings and renovations. The scheme ended in March 2021, but its effects are still being felt in the construction sector and the housing market. The state and territory governments also offered various incentives for first home buyers, such as stamp duty concessions, grants, and discounts. Third, limited supply of housing has put upward pressure on prices. The number of residential dwellings in Australia increased by only 1.6% over the year to December 2021, according to the Australian Bureau of Statistics. This was below the average annual growth rate of 1.8% over the past decade. The supply of new dwellings was affected by lockdowns, border closures, labor shortages, and rising material costs during the pandemic. The supply of existing dwellings was also constrained by low turnover rates, as many homeowners chose to stay put or renovate rather than sell. Fourth, strong demand for housing has outstripped the available supply. The demand for housing was driven by several factors, such as population growth, changing preferences, lifestyle changes, and investor activity. Population growth was mainly driven by natural increase, births minus deaths, as net overseas migration was negative due to travel restrictions. Changing preferences included a shift towards detached houses and regional areas, as more people sought more space and less density amid the pandemic. Lifestyle changes included a rise in remote work and study, which increased the demand for home offices and larger properties. Investor activity also picked up in 2021, as low interest rates and high rental yields made property investment more appealing. Fifth, increased savings have boosted the purchasing power of many Australians. The household saving ratio reached a record high of 22% in June 2020, as people reduced their spending and increased their income during the pandemic. The saving ratio declined to 12% in September 2021, but remained above the pre-pandemic level of 6%. Many households use their savings to pay down debt or accumulate deposits for buying property. These are some of the main factors that have fueled the property boom in Australia, and according to Domain's latest house price report, the median house price across all capital cities exceeded $1 million for the first time in history. At the end of this represents an annual increase of 25.2%. The strongest annual price growth was recorded in Canberra, plus 36.6%, followed by Sydney, plus 33.1%, Hobart, plus 34.4%, and Brisbane, plus 27.8%. The outlook for 2022 remains positive, but there are also some challenges and uncertainties ahead. The Australian housing market has defied the odds and risen in spite of predictions of a crash due to the COVID-19 pandemic. But this boom also comes with some challenges and risks that could threaten the stability and sustainability of the market in the future. One of the main challenges facing the housing market is affordability. With prices soaring to record levels, many potential buyers are being priced out of the market, especially first home buyers and low-income earners. According to CoreLogic, the median dwelling price in Sydney is now $1.19 million, and in Melbourne it is $9.24. This means that buyers need a large deposit and a high income to qualify for a mortgage. The high prices also widen the wealth gap between homeowners and renters and create intergenerational inequality. Another challenge is the rising level of mortgage debt that households are taking on to finance their purchases. The International Monetary Fund has warned that Australia has one of the highest risks of mortgage repayment defaults in the world due to higher levels of household debt, rising interest rates, and elevated house prices. The IMF says that households with mortgages are at greater risk of defaulting if their incomes fall or if they face unexpected expenses or shocks. This could have negative consequences for their consumption and well-being, as well as for the financial system and the economy. A related risk is the potential for interest rate hikes in the future. The Reserve Bank of Australia has kept the official cash rate at a record low of 0.1% since November 2020, but it has also indicated that it will not increase it until inflation is sustainably within the 2 to 3% target range, which is unlikely to happen before. However, some economists have argued that inflation could rise faster than expected due to supply bottlenecks, labor shortages, and fiscal stimulus. If this happens, the RBA may have to raise interest rates sooner than anticipated, which could put pressure on mortgage repayments and affordability for many borrowers. A final risk is the possibility of regulatory interventions to cool down the housing market. The Council of Financial Regulators has said that it is monitoring the situation closely and that it is prepared to take action if credit growth materially outpaces income growth. This could include imposing stricter lending standards, such as lower loan-to-value ratios or higher serviceability requirements, or introducing macroprudential measures, such as caps on investor or interest-only lending. These measures could dampen demand and slow down price growth, but they could also have unintended consequences, such as reducing credit availability or creating distortions in the market. In summary, the Australian housing market faces several challenges and risks that could affect its performance and stability in the future. While some of these risks are beyond the control of policymakers and regulators, others may require careful intervention and coordination to ensure a balanced and sustainable outcome for all stakeholders.